There is a single, devastatingly simple idea that separates the investing legends from the crowd. It's an idea so powerful that it acts as a permanent shield against catastrophic financial loss, yet so subtle that 99% of investors ignore it their entire lives. It has nothing to do with complex algorithms, inside information, or predicting the next market crash. It is the quiet foundational secret to the multi-generational wealth built by the most successful investor in history, Warren Buffett. And it begins not with what you know, but with what you are willing to admit you don't know. We are about to embark on a deep exploration of this principle, the circle of competence. This isn't just a theory, it is a weapon. By the end of our time together, you will understand how to forge this weapon from the raw materials of your own life, your own career, and your own passions. You will learn that the knowledge you already possess is a gold mine, and that by staying strictly within its borders, you gain an almost unfair advantage over the frenetic, unfocused majority. This is the blueprint for transforming your existing expertise into extraordinary portfolio growth and the bedrock of true financial freedom. Our journey is structured around 5 fundamental pillars that will build this concept from the ground up. First, we will travel back in time to witness the genesis of the circle, understanding how a young Warren Buffett forged his boundaries in the crucible of the post-war markets. Second, we will dissect the anatomy of an edge, defining what it truly means to know an industry, far beyond a surface-level familiarity. Third, we will confront the sin of drifting, exploring the powerful psychological demons of overconfidence and FOMO that lure even the smartest people into financial ruin. Fourth, we will engage in the practical work of building your fortress, a step-by-step guide to mapping and defining your own personal circle of competence. And finally, we will grasp the magnificent result, the compounding power of focus, revealing how this singular discipline fuels the kind of long-term wealth that changes not just your life, but the lives of the generations that follow. This is the path to leaving the 99% behind and joining the ranks of the truly intelligent investor. Let us begin with the first pillar, the genesis of the circle, and how a young man from Omaha, Nebraska discovered that the most important investment decision isn't what to buy, but what to ignore. To truly understand the circle of competence, we must go back to the beginning, long before the multi-billion-dollar headlines of Berkshire Hathaway, long before the world knew the name Warren Buffett. We must go back to the 1950s, to a small, unassuming office in Omaha, where a man in his late 20s was managing a handful of small investment partnerships. This was the laboratory where the principles that would build the world's greatest financial empire were first tested. And the most important rule of that laboratory was a rule of omission. Imagine the world in 1956. America was buzzing with technological optimism. The space race was igniting. Transistors were revolutionizing electronics. Companies with futuristic names like IBM, Texas Instruments, and Haloid Xerox were the darlings of Wall Street, promising a new era of explosive growth. For any ambitious young money manager, the pressure to be involved in these high-tech wonders was immense. This was the future, and if you weren't investing in it, you were a fossil, a relic of a bygone era. Yet in his letters to his partners, investors who were mostly family, friends, and neighbors who had entrusted him with their life savings, a young Warren Buffett made a shocking declaration. He would not be investing in the vast majority of these popular technology companies. He wouldn't touch complex electronics manufacturers. He wouldn't try to predict which new chemical company would strike gold. In his 1957 letter to his partners, he laid out his strategy, which he called his ground rules. The very first rule was not about finding winners, it was about avoiding losers. He explained that his investment operations would fall into 3 categories: generals, workouts, and control situations. The generals were his bread and butter, undervalued, publicly traded securities. But he attached a crucial caveat. He would only invest in companies he could understand. For a man who would become synonymous with brilliant capital allocation, his early confession is startling in its humility. He told his partners, in essence, that he was simply not smart enough to figure out the long-term competitive dynamics of these exciting new technology industries. He couldn't, with any degree of certainty, predict what a company like IBM would look like in 10 years. He didn't have a special insight into semiconductor technology. He didn't know which of the dozens of competing firms would emerge as the dominant player. This wasn't a feigned humility, it was a core operational principle. While other investors were chasing stock tips and trying to decipher complex technical jargon, Buffett was poring over the financial statements of companies that made things like bricks, windmills, and department stores. These were businesses he could understand from the ground up. He could visit the factory, he could assess the inventory, he could understand the competitive landscape in a 5-block radius. His advantage wasn't a higher IQ, it was the brutal self-awareness to know the precise perimeter of his knowledge. He was drawing a circle, and everything outside of it, no matter how popular, no matter how promising, was treated as if it didn't exist. Consider the case of Dempster Mill Manufacturing Company, a small producer of windmills and farm equipment that Buffett began buying in 1956. This was the polar opposite of a glamorous tech stock. It was a boring, old-world business in a declining industry. But Buffett understood it. He understood the value of its assets, the state of its inventory, and the inefficiency of its management. He knew that the sum of its parts was worth far more than its stock price suggested. He wasn't betting on a technological breakthrough. He was betting on simple arithmetic he could prove. He eventually took control of the company, replaced management, liquidated losing assets, and returned a handsome profit to his partners. This was a victory born not of genius prediction, but of disciplined adherence to his circle. He knew farm equipment better than he knew transistors, so that's where he played. This discipline was tested again and again. Throughout the 1960s, a period known as the go-go years, the market was infatuated with conglomerates, sprawling companies that acquired businesses in dozens of unrelated industries, promising synergistic magic. Wall Street loved them. Their stock prices soared. Analysts praised their visionary, diversified models. Buffett once again sat on the sidelines. He looked at these complex behemoths and saw not synergy, but a, quote, chaotic combination of businesses that he couldn't possibly understand as a whole. He couldn't assess the true earning power of a company that was simultaneously in aerospace, rental cars, and food processing. So he refused to play. When the conglomerate bubble burst in the late 60s and early 70s, wiping out fortunes, Buffett's partners were shielded from the carnage because he had refused to step outside the boundaries of what he could analyze with confidence. This was the genesis of the circle of competence, an operational philosophy forged in the fire of market manias, built on the radical idea that knowing your limits is a greater asset than pretending you have none. It was the first and most important step in his journey toward building unimaginable wealth. The power of Buffett's early discipline stems from a profound psychological principle known as the Dunning-Kruger effect. First identified by psychologists David Dunning and Justin Kruger in 1999, this cognitive bias describes a bizarre quirk of the human mind. People with low ability at a task tend to dramatically overestimate their own ability. Incompetent people don't just perform poorly. They are often so incompetent that they lack the very skills needed to recognize their own incompetence. You see this everywhere. The amateur singer who is certain they are destined for stardom, the novice chess player who thinks they can challenge a grandmaster, and most dangerously, the beginner investor who, after one successful stock pick, believes they have unlocked the secrets of the market. The stock market is a perfect breeding ground for the Dunning-Kruger effect. The sheer randomness of short-term price movements means that anyone, through pure luck, can make a winning bet. A person might buy a speculative tech stock based on a news headline, see it double in 3 months, and their brain doesn't register it as luck. Instead, it concludes, "I am a genius at picking tech stocks." This initial success provides a flood of dopamine and a powerful feeling of competence, but it's an illusion. They haven't actually learned anything about valuation, competitive moats, or balance sheet analysis. They have simply rolled the dice and won. Emboldened by this false confidence, they then venture further into this field where they have no real expertise. They start making bigger bets, convinced of their own prowess. This is the investor who drifts out of their circle, not because they are stupid, but because their own mind has tricked them into believing the circle is far larger than it really is. Warren Buffett's genius was in building a mental system that acted as a permanent antidote to the Dunning-Kruger effect. His approach is rooted in what is sometimes called the Socratic paradox, the famous declaration attributed to Socrates, "I know that I know nothing." This isn't a statement of ignorance, but one of profound intellectual humility. It's the recognition that the universe of knowledge is vast, and your personal island of understanding is tiny. True wisdom, therefore, isn't about expanding the island at all costs. It's about being acutely, precisely aware of its shoreline. Buffett's refusal to invest in the hot tech stocks of the 1950s was a real-world application of this principle. He was essentially saying, when it comes to the long-term prospects of semiconductor companies, I know that I know nothing. This admission wasn't a weakness. It was his greatest strength. It prevented him from confusing luck with skill. It stopped him from making bets where other people, the engineers, the industry insiders, the specialist venture capitalists, had a massive informational advantage. He was deliberately choosing to play only the games where he knew he had an edge. This conscious act of intellectual humility is the cerebral firewall that protects an investor from the siren song of overconfidence that destroys so many portfolios. It's the understanding that the most dangerous thing in investing is not being wrong, but being wrong and not even knowing you're in a position to be wrong. By defining his boundaries, Buffett short-circuited the Dunning-Kruger effect before it could ever take hold. So how do we translate this powerful historical and psychological insight into a practical tool for the modern retail investor? The first step is to build a mental model that forces you to confront the boundaries of your own knowledge. We can call this the 3 buckets model. It's a simple, tangible exercise that you can do right now to begin the process of defining your own circle of competence. Take out a piece of paper or open a new document and create 3 columns. The first column is labeled the Know It Well bucket. The second is the Can Learn It bucket. And the third, and most important, is the Too Hard pile. Now start populating these buckets. In the Know It Well bucket, you will list industries, businesses, and technologies that you understand deeply, almost intuitively. This knowledge almost always comes from one of 3 places: your profession, your serious hobbies, or your daily consumption patterns. If you've been a software engineer for 10 years, you have a deep, nuanced understanding of enterprise software sales cycles, the difference between good and bad code, and the competitive landscape between major cloud providers. That goes in the Know It Well bucket. If you are a doctor or a nurse, you understand the healthcare system, the drug approval process, and the business models of hospital chains or medical device companies. That goes in the bucket. Perhaps you're a passionate amateur mechanic who spends every weekend working on cars. You understand auto parts suppliers, the difference in quality between brands, and the coming shift to electric vehicles from a user's perspective. That too is a legitimate area of expertise. Don't discount it. This is your core circle. Next is the Can Learn It bucket. These are industries that are adjacent to your core circle, or that genuinely fascinate you, and where you believe you can, with dedicated effort over 6 to 12 months, achieve a true level of competence. For the software engineer, this might be the semiconductor industry. It's related to their core field but requires new, specific knowledge. For the doctor, it might be a specific area of biotechnology. The key here is brutal honesty. This isn't a bucket for wishful thinking. You must map out a realistic plan for how you would acquire this knowledge, what books you would read, what industry experts you would follow, what trade publications you would subscribe to. It requires a commitment to serious financial education. Finally, we come to the Too Hard pile. This is the most crucial bucket for your financial health. This is where you practice the art of intellectual humility that Buffett mastered. In this column, you list the industries that, for you, are simply unanalyzable. For most people, this bucket should be overflowing. It might include things like biotechnology forecasting, mining exploration, complex derivatives, or currency trading. These are fields where the variables are too numerous, the outcomes are too binary, or the required specialized knowledge is too far outside your experience. When you place an industry in the Too Hard pile, you are making a binding promise to yourself. You will not invest in it. You will not read analyst reports about it. You will not watch the news and get excited about a breakthrough in that field. You are treating it as radioactive. The goal of this exercise is not to feel bad about how much you don't know. The goal is empowerment. By clearly defining what's in the too hard pile, you liberate a massive amount of mental energy. You no longer have to have an opinion on everything. You are building a filter that protects you from the market's endless noise and allows you to focus your analytical firepower exclusively on the areas in your first bucket, where you have a genuine, sustainable competitive advantage. This is the first practical step in building a CEO mindset for your own portfolio. The failure to perform this simple act of intellectual sorting leads directly to the disastrous path walked by 99% of investors. This is the path of the expert-in-everything fallacy. This investor treats the stock market like a trivia night, believing they need to have a clever opinion on every topic that hits the headlines. One week, they read an article about the future of artificial intelligence, and, with no technical background whatsoever, they buy a basket of semiconductor stocks they can't even pronounce. The next week, a new weight loss drug is approved, and they immediately shift capital into a pharmaceutical company whose scientific papers they could never hope to understand. The following month, geopolitical tensions cause a spike in oil prices, so they become a temporary expert in energy futures. Their portfolio becomes a chaotic, incoherent collection of lottery tickets. It's not a strategy, it's a reaction. They are perpetually chasing yesterday's news, always one step behind the smart money. Because their knowledge is a mile wide and an inch deep, they have no real conviction in any of their positions. They don't understand the underlying business, so their only guide is the stock price itself. When the price goes up, they feel like a genius. But when the inevitable market correction comes, they have no anchor. They can't reevaluate the business's fundamentals because they never understood them in the first place. Fear takes over. They sell at the bottom, locking in their losses, only to jump into the next hot trend that flashes across their newsfeed. This cycle of chasing, buying high, panicking and selling low, is the single greatest destroyer of wealth for the average retail investor. It's a direct consequence of refusing to admit, "This is not my game to play." The 99% believe that opportunity is everywhere and they must be nimble enough to catch it. The 1% understand that true lasting opportunity is rare and found only within the strict, well-defined boundaries of their own deep competence. The financial consequences of this distinction are not abstract. They are brutally concrete and can be measured directly in your brokerage account statement. Think of your investment capital as a finite resource, an army that you command. The investor on the path of the 99% scatters their army across a dozen different battlefields, many of which are in treacherous, unknown terrain. A few soldiers may win a minor skirmish by luck, but many more will be lost in battles where they were tactically disadvantaged from the start. A single catastrophic loss, a biotech gamble that goes to zero, a speculative tech stock that implodes, can be so devastating that it wipes out the gains from 5 other successful investments. This is a strategy of guaranteed mediocrity at best and portfolio destruction at worst. In contrast, the investor who has defined their circle practices a form of financial generalship. They concentrate their entire army on a single, well-understood battlefield where they know the terrain, the enemy's weaknesses, and the paths to victory. This disciplined capital allocation has a twofold effect. First, it dramatically improves your risk management. The greatest risk in investing is not volatility, it's the permanent loss of capital. By refusing to invest in businesses you don't understand, you are erecting the single most powerful defense against permanent loss. This is the essence of effective wealth management. The preservation of capital is always rule number 1. Second, it amplifies the impact of your winners. When you have deep conviction and a handful of excellent businesses within your circle, you can make more substantial investments. A 20% gain on a concentrated position you truly understand does more for your journey to financial independence than a 50% gain on a tiny speculative bet. Defining your circle isn't just a philosophical exercise. It is the most critical decision you will make in your asset allocation strategy, directly determining your ability to achieve significant, long-term capital gains. It is the financial manifestation of knowing your limits. Now that we have established the origin of the circle, we must dissect it further. What does it actually mean to know an industry? This brings us to our second pillar, the anatomy of an edge. It's not enough to be familiar with a company's products. True competence is a multi-layered understanding of a business that allows you to see what the spreadsheets and quarterly reports can never reveal. Perhaps no story better illustrates the depth of understanding required than Warren Buffett's acquisition of See's Candies in 1972. On the surface, this was a simple, even boring business. See's sold boxed chocolates, primarily on the West Coast, through its own retail stores. There was no complex technology, no groundbreaking patents. For Buffett and his partner Charlie Munger, this was precisely the point. It was a business so simple that they could understand its every moving part. And what they understood was that See's Candies was not really in the business of selling chocolate. It was in the business of selling happiness and nostalgia. The deal was brought to them for a price of $30 million. Buffett's initial analysis, based purely on the numbers, told him it was overpriced. The company had tangible assets, factories, stores, inventory, worth only about $8 million. The asking price implied a $22 million premium for something that didn't appear on the balance sheet: the brand. At the time, Buffett was still heavily influenced by his mentor, Benjamin Graham, the father of value investing, who taught him to buy businesses for less than their liquidation value. By that metric, See's was no bargain. But Munger pushed him to look deeper, to see the business not just as an accountant would, but as a customer would. They began to investigate. They understood that when a customer bought a box of See's Candies, especially for a gift, the price was not the primary consideration. The primary consideration was the emotional reaction of the person receiving the gift. A man buying chocolates for his girlfriend on Valentine's Day wasn't trying to save $2. He was trying to create a moment of joy and affection. Giving a box of See's sent a message of quality and thoughtfulness. The brand was a proxy for the emotion. This gave See's incredible pricing power. They could raise their prices by 10% each year, and customers would barely notice, because the incremental cost was tiny compared to the emotional payload of the gift. This was a moat, a competitive advantage, that was invisible to a traditional financial analyst just looking at price-to-earnings ratios. Buffett and Munger dug deeper into the customer psychology. They saw that See's had become a tradition for families. People who had received See's as children would then buy it for their own children. The stores, with their black and white checkered floors and friendly service, were part of the experience. The act of buying the candy was itself a pleasant ritual. This created a level of customer loyalty that was almost unbreakable. A competitor could open a store next door and sell chocolates for 20% less, but they couldn't replicate the decades of happy memories associated with the See's brand. This was an asset more valuable than any factory. Ultimately, they paid the $25 million that the sellers would finally agree to. Over the subsequent decades, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was an absolute home run. The success of the See's investment taught Buffett a crucial lesson that transformed his approach to investing. It taught him that the most important financial metrics of a business are often not found in the financial statements. True understanding, true competence, required an almost anthropological analysis of the business, its relationship with its customers, the strength of its brand, its culture, and its long-term competitive position. It's about understanding why people buy the product, why they keep buying it, and what it would take for them to stop. That is the anatomy of a true investment edge. The mental trap that See's Candies helps us avoid is a cognitive bias known as the availability heuristic. This is a mental shortcut our brains use where we judge the likelihood of an event based on how easily examples of it come to mind. It's why people are often more afraid of flying than driving. Plane crashes are rare, but are vivid, dramatic, and heavily reported in the news, making them highly available in our memory. In investing, the availability heuristic manifests in a dangerous way. Investors tend to focus on the information that is easiest to get, not the information that is most important. What's the easiest information to get about a public company? The stock price. It's updated every second, displayed in bright green or red. The next easiest is quarterly earnings reports and the accompanying news headlines. Company X beats earnings estimates, or Company Y misses revenue targets. This readily available, constantly changing data creates the illusion of knowledge. An investor can track these numbers, read the headlines, and feel like they are on top of their investment. But they are confusing information with insight. They are watching the scoreboard, not the game. They are suffering from what you might call the spreadsheet jockey syndrome, the belief that if you can model a company's cash flows in a spreadsheet, you understand the business. Buffett's analysis of See's Candies was a deliberate rejection of the availability heuristic. He forced himself and Munger to look past the easily available data, the book value, the P/E ratio, and search for the hard-to-quantify but critically important factors. How do you put customer nostalgia into a spreadsheet cell? How do you model the pricing power derived from gift-giving psychology? You can't. This deeper level of understanding requires effort. It requires talking to customers, visiting stores, studying the company's history, and thinking critically about its place in the culture. It means fighting the brain's natural tendency to settle for the easy answer. Furthermore, true experts can fall victim to a related bias, the curse of knowledge. This is a cognitive bias, where someone who is communicating with others assumes that the others have the background to understand. In investing, this often happens when an expert in one field assumes their expertise automatically translates to understanding a business. A brilliant software engineer might look at a retail company and dismiss it as simple, failing to appreciate the immense complexity of supply chain management, brand marketing, and real estate strategy. Their very expertise in one domain blinds them to the deep, nuanced expertise required in another. The anatomy of a true edge requires the humility to recognize that every industry has its own unique, complex ecosystem. It demands that you replace the easily available metrics with a deep, qualitative understanding of the business's fundamental competitive advantage. This is how you move from being a financial analyst to becoming a true business analyst, which is the key to successful long-term investing. To develop this deeper level of business analysis within your own circle, you need a structured mental model. Let's call it the 4 questions of competence. Before you ever invest a single dollar in a company, even one that falls squarely within your know-it-well bucket, you must be able to answer these 4 questions with detail and confidence. The first question is, can I explain this business to an intelligent 10-year-old in 2 minutes and have them understand it? This is the ultimate test of clarity. If you can't distill the essence of how a company makes money into a simple, jargon-free explanation, it's a red flag that you don't understand it as well as you think you do. Saying, they are a leading provider of synergistic, cloud-based enterprise solutions is a failure. Saying, they make software that helps big companies keep track of all the stuff they buy is a success. This isn't about dumbing down the analysis. It's about achieving a level of understanding so profound that you can see the simple core of a complex operation. If you can't do this, you must go back and study more before proceeding. The second question is, who are the company's 5 most important customers, and why do they choose this company over its competitors? This question forces you to move beyond your own perspective and analyze the business from the outside in. The customers might be individual consumers, other corporations, or even governments. You need to understand what they value. Is it price, quality, service, integration with other products? Is there a high switching cost that locks them in? Answering this question will reveal the company's competitive advantage or lack thereof. For See's Candies, the answer was about brand trust and emotional connection. For Microsoft, it's about the high switching costs of its enterprise software ecosystem. If you don't know why the customers are loyal, you can't predict if they will remain loyal. The third question is the inversion question, inspired by Charlie Munger. If I were given unlimited capital, how would I try to destroy this business? This forces you to think like a competitor. What are the company's vulnerabilities? Is its technology aging? Is its brand falling out of favor with a younger generation? Is it dependent on a single supplier? Could a new startup with a better business model undercut its prices and steal its customers? By mapping out the most likely avenues of attack, you gain a much clearer picture of the durability of the company's moat. A truly great business is one that you find very, very difficult to compete with, even in your imagination. The fourth and final question is, what is the single biggest undeniable trend, be it technological, cultural, or regulatory, that could render this business obsolete in the next decade? This question protects you from the silent killer of many great companies: gradual irrelevance. Think about Kodak and the rise of digital photography, or Blockbuster and the rise of streaming video. These companies were dominant in their day, but they were standing in the path of an unstoppable technological train. You must honestly assess if your potential investment is on the right side of history. Is it a beneficiary of a powerful tailwind, or is it fighting a losing battle against a gale force headwind? Answering these four questions transforms you from a passive stock picker into an active business analyst. It provides the framework for building the deep, qualitative understanding that forms the true anatomy of an investment edge. The vast majority of investors never engage in this level of deep analysis. The path of the 99% is the path of the spreadsheet jockey. This is the investor, often highly intelligent and analytical, who believes that understanding a business is synonymous with mastering its financial model. They can build intricate spreadsheets that project revenues, margins, and cash flows out for 10 years, complete with sensitivity analyses and discounted cash flow valuations calculated to 2 decimal places. They feel a sense of control and precision because their model is mathematically elegant. The fatal flaw of the spreadsheet jockey is that their model is built on a foundation of assumptions, and if those assumptions are based on a shallow understanding of the business, the entire elegant structure is worthless. Garbage in, garbage out. A perfect example would be an analyst in the early 2000s looking at a major newspaper company like the Tribune Company. They could have built a flawless financial model. They would have seen a history of stable revenues, high profit margins, and a dominant position in its local market. Their spreadsheet would have screamed "buy why," but the model would have completely missed the one factor that mattered more than anything else: the internet. The spreadsheet couldn't quantify the existential threat of Craigslist decimating the classified ads business, which was the primary source of the newspaper's profits. It couldn't model the cultural shift of people getting their news online for free. The analyst understood the company's financials, but they did not understand the business. They missed the crumbling of the competitive moat. They were focused on the numbers on the page, not the tectonic shifts happening in the world outside. This is a recurring tragedy in the investment world. Investors fall in love with the precision of their models and forget that the real world is messy, qualitative, and driven by human psychology and technological change. Deep knowledge of an industry provides the critical context for the numbers. It allows you to question the assumptions that go into the model. It's the difference between being a calculator and being a strategist. The 99% are calculators. The intelligent investor, operating within their circle of competence, is a strategist. This deep, strategic understanding connects directly to the most important metrics of financial success. When you can identify a business with a durable competitive advantage, a real moat, what you are really identifying is a business with pricing power. Pricing power is the ability to raise prices over time without losing significant business to competitors. This is the holy grail of business, and it manifests directly on the financial statements. Companies with strong pricing power, like See's Candies, consistently exhibit high and stable gross profit margins. As their costs go up, they can pass those costs along to customers, protecting their profitability. Furthermore, a deep understanding of the business allows you to assess its return on invested capital, or ROIC. This metric measures how efficiently a company is using its capital to generate profits. A great business like See's can grow for decades while requiring very little new capital investment. It becomes a cash-generating machine. An inferior business, on the other hand, might have to spend enormous sums on new factories or research and development just to stay competitive, resulting in a low ROIC. An investor who only looks at revenue growth can be easily fooled. A company can grow its revenues by 50% a year, but if it has to spend $1 of capital to generate 5 cents of profit, it's a terrible business that is destroying value, not creating it. An investor with a deep circle of competence can distinguish between good growth and bad growth. They can see beyond the top-line revenue number and focus on the true engine of wealth creation: sustainable, high return on capital profitability. This is not just a theoretical advantage, it is a direct financial connection that allows you to select companies that are mathematically primed for long-term portfolio growth and avoid those that are destined for mediocrity. Knowing where your circle is and what constitutes true knowledge within it are foundational. But perhaps the most difficult challenge in investing is not one of intellect, but of temperament. It's the battle against the powerful internal forces that constantly tempt us to abandon our discipline. This brings us to our third pillar, the sin of drifting. We must explore the psychology of overconfidence and the fear of missing out, the twin demons that have lured countless investors out of the safety of their circle and into the abyss of financial ruin. There is no more dramatic or instructive story of the sin of drifting and the immense rewards of resisting it than Warren Buffett's conduct during the dot-com bubble of the late 1990s. The period from 1995 to early 2000 was one of collective madness. The rise of the internet had convinced the world that a new economy had been born, one where the old rules of valuation and profitability no longer applied. Companies with no revenue, no profits, and often no viable business plan were going public and seeing their stock prices multiply overnight. Cab drivers were trading tech stocks between fares. The media fanned the flames, celebrating a new generation of tech billionaires and portraying anyone who questioned the frenzy as a dinosaur. And in the middle of this euphoric hurricane stood Warren Buffett, resolutely doing nothing. Berkshire Hathaway, the very symbol of intelligent capital allocation, was sitting on tens of billions of dollars in cash, and Buffett refused to invest it in the technology and internet stocks that were making everyone else rich. He was publicly and repeatedly questioned about this. Journalists, analysts, and even his own shareholders grew impatient. In 1999, a Barron's cover story famously asked, "What's wrong, Warren?" The article suggested he had lost his touch, that he was an old man who simply didn't get the new paradigm. He was mocked for being out of step, for clinging to his old-world businesses like insurance, railways, and Coca-Cola, while the real action was happening in Silicon Valley. The pressure on him was unimaginable. Imagine seeing your neighbors, your friends, people you know are less experienced investors than you, making fortunes seemingly overnight in stocks you refuse to buy. Imagine being one of the most famous investors in the world and having the entire financial media declare that your methods are obsolete. This is a level of psychological pressure that would break almost anyone. But Buffett did not break. His reasoning was devastatingly simple and consistent with the principle he had honed for over 40 years. He stated, publicly and privately, that he did not understand these businesses. He could not, with any level of certainty, project what companies like GeoCities or Pets.com would look like in 10 or 20 years. He couldn't identify a durable competitive advantage in a field where technology was changing by the month and dozens of companies were competing for the same space. He famously said, "The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage." The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. He acknowledged that the internet was a world-changing technology, but he separated that observation from the investment proposition. He knew that in past technological revolutions, like the automobile or the airplane, the initial frenzy produced hundreds of companies, the vast majority of which went bankrupt, even though the technology itself succeeded. He could not confidently pick the long-term winners, so because it fell outside his circle of competence, he refused to play the game. When the dot-com bubble burst in March of 2000, the result was a financial cataclysm. The Nasdaq index, which was heavily weighted with these tech stocks, fell by nearly 80% over the next 2 years. Trillions of dollars of paper wealth evaporated. The genius investors of 1999 were wiped out. People who had quit their jobs to become day traders lost their life savings. And Warren Buffett, the man who had been mocked as a relic, was revealed to have been the wisest man in the room. His discipline not only protected Berkshire's capital from the crash, but left him with a massive war chest of cash to deploy into the wreckage, buying great businesses at bargain prices. His refusal to commit the sin of drifting, even under immense social and professional pressure, cemented his legacy and provided the most powerful lesson in investment history about the protective power of staying within your circle. The psychological forces that drove the dot-com mania are the same forces that constantly tempt us to stray from our own circles of competence. The first and most powerful of these is herd mentality, also known as social proof. This is a deep-seated psychological bias where we tend to assume that the actions of others reflect the correct behavior for a given situation. If everyone is running out of a building, your first instinct isn't to rationally assess the situation, it's to start running too. In investing, this manifests as a powerful urge to buy what everyone else is buying. When a stock's price is soaring and it's all over the news and your friends are talking about it, a voice in your head says, "All these people can't be wrong. They must know something I don't." This herding instinct is a remnant of our evolutionary past, where conforming to the tribe was essential for survival. But in financial markets, the herd is almost always wrong at critical turning points. The herd buys at the peak of euphoria and sells at the bottom of despair. Buffett's superpower during the dot-com bubble was his ability to completely insulate himself from the judgment of the herd. He relied on his own internal scorecard, his own rational analysis, rather than the external validation of the crowd. He knew that in investing, popularity is a terrible indicator of value. In fact, the two are often inversely correlated. The second demon is a specific form of loss aversion that we call FOMO, or the fear of missing out. Traditional loss aversion states that the pain of losing a dollar is psychologically about twice as powerful as the pleasure of gaining a dollar. FOMO is the application of this principle to opportunity. The sight of others getting rich from an investment you didn't make creates a powerful, painful feeling of opportunity loss. It feels like you are losing money, even though your own capital is safe. This psychological pain can become so intense that it overrides all rational judgment. It forces people to abandon their carefully constructed investment strategy and pile into a hot asset at the most dangerous possible time, after it has already experienced a massive run-up. FOMO is the engine of every speculative bubble in history, from Dutch tulips in the 1600s to the tech stocks of the 1990s. Resisting FOMO requires an almost Zen-like temperament, a comfort with the idea that you will miss out on many winning trades, and that this is not a failure, but a necessary cost of a disciplined, long-term strategy. Buffett was perfectly content to miss the ride up in Yahoo and Amazon because the risk of participating in something he didn't understand was, to him, far greater than the pain of missing the gains. To defend against these powerful psychological enemies, you need to pre-install a mental firewall. You need an immediate, automatic process that kicks in the moment you feel the pull of FOMO. Let's call this the FOMO inoculation protocol. It's a simple but profoundly effective thought exercise. The next time you feel that irresistible urge to buy a hot stock that is outside your circle of competence, a stock everyone is talking about, you are forbidden from buying it immediately. Instead, you must perform a single task. You must take out a piece of paper and write a one-page pre-mortem. A pre-mortem is the opposite of a post-mortem. Instead of analyzing a failure after it has happened, you imagine in vivid detail that it has already happened. The heading of your page should be, "It is 1 year from today, and my investment in Company X has lost 90% of its value. Here is what most likely happened." Then, you must write out the story of the failure. You cannot be vague. You must come up with plausible, concrete reasons for the collapse. Did a major competitor release a superior product? Did the company's technology turn out to be a dead end? Was the valuation so stratospherically high that even a minor hiccup in growth caused a complete collapse in the stock price? Did a regulatory change destroy the business model? Was the management team revealed to be fraudulent? This exercise does two crucial things. First, it forces you to switch from the emotional, FOMO-driven part of your brain, the amygdala, to the rational, analytical part, the prefrontal cortex. You simply cannot complete the task without engaging in critical thinking. Second, it systematically dismantles the rosy, best-case scenario narrative that is driving your FOMO. Bubbles are sustained by a collective refusal to consider the downside. The pre-mortem forces you to stare directly at the downside. By the time you have finished writing out the plausible paths to ruin, the emotional urgency to buy the stock will have significantly faded. In many cases, you will look at your own pre-mortem and realize that the risks are far greater than you had initially perceived. This simple 10-minute exercise can be the shield that stands between your hard-earned capital and the destructive impulses of herd mentality. It is the practical application of Buffett's rational detachment in the face of market madness. The 99% of investors have no such protocol. For them, the path is one of emotional capitulation. The archetype of this path is the dot-com day trader from 1999. Let's create a profile. Imagine a man named Frank. Frank is an accountant, a perfectly smart and responsible person in his normal life. But in 1998, he opens a brokerage account. He makes a few lucky bets on tech stocks and triples his initial small investment. He is flooded with a sense of genius and power. He starts reading message boards online, sharing tips with other amateur traders. He convinces himself he has a, quote, system. The herd mentality is in full effect. He is part of a tribe of other new economy geniuses. Soon, the FOMO becomes unbearable. He sees teenagers becoming millionaires, and he feels like he is being left behind, that his secure but boring accounting job is a trap. He makes the fateful decision. He quits his job to become a full-time day trader. He leverages his account, borrowing money to make even bigger bets. For a few months in late 1999, he feels like the king of the world. His account value soars. But he doesn't understand any of the businesses he is buying. He owns tickers, not companies. His only strategy is to buy what's going up and hope it keeps going up. Then comes March of 2000, the bubble pops. The stocks he owns start to fall. At first, he sees it as a buying opportunity. He doubles down. But they keep falling. 10%, 20%. Now the panic starts to set in. He's getting margin calls from his broker. The euphoria of the tribe is replaced by a collective, silent terror. He has no analytical anchor to hold on to, no understanding of the underlying value of his holdings. His only guide, the price, has turned against him. He finally succumbs to the fear and sells everything near the bottom, crystallizing a catastrophic loss. He has lost not only his entire life savings but also his career. Frank's story, and the stories of millions like him, is the inevitable tragedy of drifting outside one's circle. It's a journey that starts with the siren song of easy money and ends in the silence of financial ruin. The discipline to resist that song is what separates a fleeting gamble from a lifetime of wealth creation. The financial impact of this discipline can be quantified and understood as the FOMO tax. Every time an investor capitulates to FOMO and buys an overvalued, popular asset outside of their competence, they are paying a hidden tax on their future returns. This tax has several components. First, there's the immediate cost of likely buying at a high price, as FOMO is most powerful at the peak of a trend. Second, there is the high probability of selling at a loss when the trend inevitably reverses, as these investments are held without real conviction. But the most significant component of the FOMO tax is the opportunity cost. The capital that is destroyed in these speculative gambles is capital that can no longer be used for sensible long-term investments within your circle of competence. It is money that can no longer compound. Imagine two investors, both starting with $100,000. Investor A is disciplined. She invests only in businesses she understands, earning a steady, boring 10% per year. Investor B is a chaser. He makes 50% in a hot sector one year, then loses 40% the next when the bubble bursts. He has another good year, then another big loss. Over 30 years, Investor A, the steady compounder, will have over $1.7 million. Investor B, despite his occasional spectacular gains, will likely have far less and may have even lost his principal. The chart of his portfolio will be a violent EKG of booms and busts. The chart of Investor A's portfolio will be a smooth, upward-sloping line. The massive difference in their final net worth is the accumulated FOMO tax. Avoiding this tax, by simply refusing to play games you don't understand, is one of the most powerful levers you can pull to ensure your journey towards financial independence and superior portfolio growth. We have now seen why the circle is necessary, what it's made of, and the dangers of leaving it. The next logical step is to turn inward. The theory is useless without application. This brings us to our fourth, and perhaps most practical, pillar: building your fortress. This is the manual, the step-by-step process for systematically identifying, mapping, and defining the boundaries of your own unique circle of competence. The story that perfectly captures the essence of identifying and respecting competence comes not from a stock market transaction, but from one of Buffett's most famous business acquisitions, Nebraska Furniture Mart, in 1983. The central character of this story is not Warren Buffett, but a tiny, indomitable Russian immigrant named Rose Blumkin, better known as Mrs. B. Mrs. B fled Russia in 1917 and arrived in America unable to speak a word of English. In 1937, with a loan of just $500, she started a small furniture store in the basement of her husband's shop in Omaha. Her business philosophy was brutally simple: sell cheap and tell the truth. She worked tirelessly, buying directly from manufacturers to cut out middlemen, and she passed those savings on to her customers. She was famous for her razor-thin margins and her ferocious negotiation skills. By the early 1980s, Nebraska Furniture Mart was an Omaha institution, a massive retail complex that was doing hundreds of millions of dollars in annual sales, dominating the entire Midwest furniture market. It had been built entirely through Mrs. B's singular focus and deep, almost obsessive knowledge of the retail furniture business. She knew everything: the manufacturing cost of every sofa, the shipping logistics, the psychology of her customers. The furniture business was her entire world. It was her circle of competence, and within it, she was an undisputed genius. Warren Buffett had been a customer of Mrs. B's for decades. He had watched her build this empire from nothing. He recognized that her success wasn't an accident. It was the result of a perfectly defined and flawlessly executed business strategy within a domain she had completely mastered. One day in 1983, Buffett walked in to see Mrs. B, who was then 89 years old. He told her he wanted to buy her business. He didn't ask to see audited financial statements. He didn't bring a team of lawyers or accountants to do due diligence. He simply asked her, "How much do you want?" They agreed on a price, around $60 million, and Buffett wrote a check. The entire contract was a simple, two-page document. When asked later why he did a multi-million-dollar deal with such a stunning lack of traditional analysis, Buffett's answer was profound. He said he didn't need to check the numbers because he was buying two things: a business with a powerful and durable competitive moat built on low prices, and the absolute integrity and competence of Mrs. B. He knew her circle of competence was real, deep, and impenetrable. He wasn't just buying a store. He was buying a fortress of expertise. The story of Mrs. B is the ultimate parable for building your own circle. It's about finding that one area where, through experience, passion, and hard work, you can become the undisputed expert. Your circle might not be as large as Mrs. B's, but the principle is the same. It's about achieving a level of mastery in a defined domain that gives you an undeniable edge. To build this fortress of expertise for yourself, you must first understand the psychological principle that underpins expert decision-making. Researchers have studied how experts, like master chess players, elite firefighters, or trauma surgeons, make consistently high-quality decisions under pressure. They don't do it by methodically weighing all possible options like a computer. Instead, they use something called the Recognition Primed Decision (RPD) model. After thousands of hours of experience, their brains have built up a massive internal library of patterns. When faced with a new situation, they rapidly and unconsciously scan it against this library. They don't see a collection of random data, they see a familiar pattern, and this pattern recognition immediately suggests a course of action. A fire captain arriving at a burning building doesn't run through a checklist of 100 items. His experience allows him to glance at the color of the smoke, the location of the flames, and the structure of the building, and he instantly knows this is a pattern X fire. The immediate risk is roof collapse, and the best course of action is a defensive attack from the outside. This intuitive leap is not magic. It is the fruit of deep, specialized experience. The goal of defining your circle of competence is to build this same pattern recognition ability for a specific sector of the business world. You want to reach a point where you can look at a company in your industry and instantly recognize the patterns of a durable competitive advantage or the subtle signs of impending trouble. This can only be achieved through focused immersion. An investor who spends 1 week studying banking, the next studying software, and the next studying energy will never build this deep library of patterns in any of them. They will remain a perpetual novice. But an investor who commits to spending 5 years exclusively studying, for example, the enterprise software industry, will start to see things that the generalist can never see. They will develop a feel for the business, an intuitive understanding of the competitive dynamics that allows for faster, more accurate decision-making. Your circle is the training ground, where you accumulate the thousands of hours of deliberate practice required to turn conscious analysis into unconscious expertise. Now let's translate this into a concrete step-by-step process. We'll call it the competence mapping process. This is the practical work of drawing the map of your own fortress. Step 1. The professional inventory. Take out a piece of paper and list every job you have ever had, from your first summer job to your current position. Next to each job, write down the industry it was in. Be specific. Not just technology, but enterprise data storage or consumer mobile app development. For each role, list 3 specific skills or pieces of knowledge you acquired. Did you learn about supply chain logistics, government regulation in the healthcare space, the sales cycle for industrial machinery? This is the foundation of your competence, built through thousands of hours of paid-for experience. This is your most valuable, non-obvious asset as an investor. Step 2. The passion audit. List your 3 most expensive or time-consuming hobbies. Are you a passionate gamer who understands the economics of the video game industry? A dedicated home cook who knows the difference between high-quality kitchenware brands? A fitness enthusiast who has a deep understanding of gym chains, supplement companies, and athletic apparel? Often the areas we are passionate about are the ones where we have absorbed a huge amount of knowledge effortlessly. This passion provides the motivation to do the deep research that investing requires, turning work into play. Step 3. The consumption analysis. List the 5 products or services you have willingly paid for consistently for the last 5 years or more. What brands have earned your unwavering loyalty? Your auto insurance provider? Your favorite coffee shop? The smartphone in your pocket? Your loyalty as a consumer is often a clue to a powerful business model or a strong brand moat. Investigate these companies. Why have you stuck with them? What would it take for a competitor to win your business? You are already an unpaid expert on these businesses from a customer's perspective. Step 4. The overlap and focus. Now look at the list you've created from the first 3 steps. Where are the overlaps? Where do your professional experience, your passions, and your consumption habits intersect? Perhaps you work in marketing, professional, are an avid social media user, passion, and are a loyal customer of a particular apparel brand, consumption. This intersection points directly to a potential circle of competence. Direct-to-consumer, retail, and brand marketing. This is your starting point. This is the area where you will focus all of your investment research for the next year. Your goal is not to find a stock to buy tomorrow. Your goal is to become one of the smartest amateur analysts in the world on this specific niche. You will read the quarterly reports of every public company in this space. You will follow industry journalists and executives. You will build your pattern library. This focused effort is how you construct the walls of your fortress, brick by brick. The failure to undergo this structured process of self-assessment leads to the trap of analysis paralysis. This is the investor who understands the importance of knowledge, but is so overwhelmed by the sheer volume of information that they never take action. They feel they need to understand the entire global economy, every sector of the S&P 500, and the nuances of monetary policy before they can possibly invest in a single stock. They spend years reading books, watching financial news, and learning surface-level details about hundreds of different industries. They become a jack of all trades, master of none. Because they never develop deep, conviction-level knowledge in any one area, they never feel confident enough to make a concentrated investment. Their paralysis ultimately leads them to one of two outcomes. Either they do nothing, leaving their money in cash where it is eaten away by inflation, or they give up and simply buy an index fund. Now, buying an index fund is a perfectly reasonable strategy for many people, but it is an admission that you cannot or will not do the work to beat the market. For the investor who desires to achieve truly superior returns, who wants to build significant wealth through active stock picking, analysis paralysis is a dead end. It is the antithesis of the focused, confident action demonstrated by Mrs. B. The competence mapping process is the cure for this paralysis. It gives you permission to ignore 99% of the market. It provides a clear, manageable starting point, transforming the impossible task of understanding the stock market into the achievable goal of understanding the handful of businesses I am uniquely qualified to analyze. The financial connection here is one of the most powerful in all of finance, the link between focus and concentration. Building a defined circle of competence gives you the analytical confidence to move beyond the traditional advice of broad diversification. The 99% path often leads to what Peter Lynch called diversification, owning so many different stocks, 30, 40, 50 or more, that your portfolio essentially becomes a closet index fund, but with higher fees and more effort. You own a little bit of everything, have no deep knowledge of anything, and your returns are doomed to be average. The fortress of competence allows for a different, more potent approach to asset allocation. It allows for intelligent concentration. When you have done the deep work on an industry and have identified a truly outstanding business within it, you can make a significant investment. Instead of a 50-stock portfolio where each position is a meaningless 2% of your assets, you can build a 10 to 15-stock portfolio where your best ideas can meaningfully impact your overall net worth. Buffett himself has said that wide diversification is only required when investors do not understand what they are doing. This is not a call for reckless gambling. It is a call for a level of research and understanding so profound that a concentrated position is actually less risky for you than a diversified portfolio of businesses you don't understand. This is the CEO mindset applied to personal finance. A CEO doesn't run 50 different companies. They run one, and they know it inside and out. By building your fortress, you gain the conviction to make these larger, more impactful bets, which is the direct, mathematical path from average returns to the kind of portfolio growth that can lead to true financial independence. We have arrived at the final stage of our journey. We've explored the origins of the circle, defined what true competence means, faced the demons that lure us away, and laid out a blueprint for building our own. Now we must understand the ultimate reward for this immense discipline. This is our fifth and final pillar, the compounding power of focus. We will see how staying within your circle is not a defensive, limiting strategy, but is in fact the most powerful engine for offensive, long-term wealth creation. To witness the explosive financial power of a well-defined circle, we must examine one of the most audacious and brilliant investments of Warren Buffett's career, his 1964 investment in American Express. This was not a calm, analytical purchase of an undervalued company in normal times. This was a massive bet-the-farm investment made in the midst of a full-blown, headline-grabbing panic. In late 1963, a major scandal erupted. A company called Allied Crude Vegetable Oil, a large customer of American Express's warehousing division, was discovered to be a massive fraud. They had been securing huge loans using warehouse receipts for giant tanks of salad oil as collateral. The problem was, the tanks were mostly filled with seawater, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude went bankrupt, and the banks that had loaned them money were on the hook for massive losses. Losses they expected American Express to cover, as it was their receipts that had guaranteed the collateral. The market panicked. The central question was whether the fraud would bankrupt American Express itself. The company's stock price was cut in half in a matter of weeks. Wall Street was terrified. Investors, operating on fear and incomplete information, dumped the stock indiscriminately. It seemed like the smart thing to do. But this is where Buffett's circle of competence gave him a monumental advantage. While most investors saw American Express as a single tainted entity, Buffett's deep understanding of the financial services and insurance industries allowed him to see it as two separate businesses. There was the small, tarnished warehousing division where the fraud had occurred. And then there was the giant, immensely profitable core business, the credit card and the traveler's checks. His circle wasn't in salad oil, it was in the psychology of consumer finance and the business of trust. So he set out to answer a single question. Was the scandal affecting the core business? Was the public's trust in the American Express brand being eroded? He didn't rely on analyst reports. He did his own primary, on-the-ground research. He visited restaurants and travel agencies. He talked to merchants and customers. He observed people paying for meals and saw that they were still proudly using their American Express cards. He went to banks and saw that people were still buying American Express traveler's checks without hesitation. His investigation revealed a crucial insight. The public mentally separated the salad oil scandal from the core products they used and trusted. The brand's moat was intact. He concluded that the damage was contained to the warehousing division and that the losses, while significant, would not be fatal to the parent company. He realized the market was panicking, pricing the entire magnificent business as if it were going to zero because of a problem in one small, non-essential division. While everyone else was selling in fear, Buffett saw the opportunity of a lifetime. He took 40% of his investment partnership's entire capital, a massive, concentrated bet, and plowed it into American Express stock. Within 2 years, the stock had more than tripled, and his partners had made a fortune. This single investment, born from deep knowledge and the courage it creates, was instrumental in building the foundation of Berkshire Hathaway. It was a clear demonstration that a well-understood circle doesn't just help you find good companies. It gives you the conviction to act decisively when those great companies are on sale. The psychological principle that allowed Buffett to act while others were frozen in fear is the antidote to one of the most common investment biases, confirmation bias. Confirmation bias is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs. Once an investor believes a stock is bad or doomed, they will unconsciously filter the news to find evidence that supports that belief. During the salad oil scandal, the dominant belief was, American Express is in trouble. Every negative headline, every analyst downgrade, confirmed this view for the average investor, creating a feedback loop of fear. Staying within your circle of competence is a powerful weapon against this bias. Because Buffett had a deep, pre-existing understanding of the financial services business, he wasn't starting from a place of fear, he was starting from a foundation of facts. His mental model of the business was robust. This allowed him to evaluate the new information, the scandal, objectively. He wasn't looking for evidence to confirm a panic-induced belief. He was looking for evidence to test his fundamental thesis about the company's long-term earning power. This is a critical distinction. An investor outside their circle is swayed by headlines and sentiment because that's all they have to go on. An investor inside their circle can distinguish between the signal, the health of the core business, and the noise, the market panic. Furthermore, this deep knowledge creates a positive version of another bias, the endowment effect. The endowment effect is the tendency for people to overvalue something simply because they own it. For most investors, this is a danger, as it can cause them to hold on to losing stocks for too long. But for an intelligent investor, deep business knowledge creates a sense of intellectual ownership that is incredibly powerful. You don't just own a stock, you feel you own a piece of the business, a business you understand as well as if you were running it. This powerful sense of ownership is what gives you the fortitude to hold on during market crashes and even to buy more when others are panicking. It's not a blind faith. It is a justified conviction built on a mountain of research and analysis. This is the temperament that separates the amateur from the professional. To cultivate this level of conviction in your own investments, you need a process for continually reinforcing and testing your thesis. Let's call this final mental model the conviction ledger. This is a simple journaling practice that you will perform for every stock you own in your concentrated portfolio. For each company, you start a new ledger. The first entry is your original investment thesis. You must write out, in detail, the answers to the 4 questions of competence that we discussed earlier. Why did you buy this business? What is its moat? Who are its customers? What are the risks? This is your baseline. Then, every quarter, when the company releases its earnings report, you must make a new entry in the ledger. Your task is to update the thesis. You will summarize the key points from the quarterly report and answer 3 questions. 1. What new information confirms my original thesis? 2. What new information challenges my original thesis? 3. Based on this, has my conviction in this business increased, decreased, or stayed the same, and why? This simple, disciplined practice does several things. It forces you to actively follow your companies, not just passively own the stocks. It makes you confront disconfirming evidence, acting as a direct check on confirmation bias. Most importantly, it builds a written record of your thinking over time. When a market panic hits and the stock price of one of your companies drops 30%, you will not be guided by fear. You can go back and read your conviction ledger. You can review a year's worth of rational quarterly analysis. This ledger becomes your anchor in the storm, reminding you of the fundamental reasons you own the business and giving you the evidence-based courage to hold on or even buy more, just as Buffett did with American Express. The 99% of investors who operate without this deep, conviction-building process are destined to become the panicked seller. This investor might even do a decent job of picking a good company initially. They might buy a great business for a reasonable price, but because their understanding is shallow, perhaps they bought it based on an analyst report or a friend's tip, their conviction is brittle. The first sign of trouble, a market crash, a bad quarterly report, a negative news story, shatters their confidence. They have no conviction ledger to fall back on, no deep well of their own research to provide stability. The fear of further losses becomes overwhelming. They watch the stock price fall, and their mind extrapolates the decline to zero. They forget the long-term thesis, if they ever truly had one, and focus only on the short-term pain. So they sell. They capitulate at the point of maximum pessimism. And in doing so, they commit the cardinal sin of investing. They turn a temporary mark-to-market loss into a permanent, realized loss of capital. And often, they watch in agony as the company recovers and the stock goes on to new highs without them. This cycle of buying right but selling wrong is a tragically common story. It is the direct result of having an understanding that is too shallow to withstand the psychological pressure of volatility. The compounding power of focus is not just about picking winners. It's about having the deep, unshakable conviction required to hold on to those winners for long enough to let them work their magic. This brings us to the ultimate financial connection, the time arbitrage dividend. The stock market is dominated by professionals, fund managers, analysts, traders, who are under immense pressure to show strong performance every quarter or even every month. Their careers depend on it. This short-term focus creates a massive inefficiency in the market. They will often sell a great long-term business because of a temporary problem that might make the next 2 quarters look bad. An individual investor operating within their circle of competence has a structural advantage over these professionals. You don't have a boss to report to. You don't have clients who will pull their money if you have one bad quarter. Your time horizon can be decades. This allows you to exploit what is called time arbitrage. You can buy the great businesses that the short-term oriented market is foolishly selling, because your deep understanding of the business gives you the conviction to look out 5 or 10 years. The salad oil scandal was a perfect example. Wall Street was focused on the next 6 months of headlines and potential losses. Buffett was focused on the next 10 years of credit card and traveler's check profits. This ability to confidently take the long view when others are myopically focused on the present is a direct result of staying within your circle. This is not just an edge, it is perhaps the single greatest edge a retail investor has. The profits you generate from buying great companies during periods of temporary turmoil and holding them for the long term are your time arbitrage dividend. It is the massive, tangible financial reward for years of focused study and disciplined patience. It is how you harness the incredible power of compounding, and it is the final, magnificent outcome of committing to the principle of the circle of competence. You have just been given a powerful mental tool. You've journeyed through the core philosophy that built one of the world's greatest fortunes. You now understand that the secret to beating 99% of other investors is not about expanding your knowledge to infinity, but about defining the precise boundaries of what you already know and having the discipline to never, ever step outside them. You have seen how this single idea shields you from the psychological biases that destroy portfolios, and how it translates your own unique life experience into a tangible, powerful financial advantage. This knowledge, once acquired, can never be taken from you. It is a permanent upgrade to your decision-making software. But it's crucial to understand that Warren Buffett's system is not a single pillar. It is a grand cathedral built upon several interconnected principles. The circle of competence is the foundation. It tells you where to hunt for opportunities. It gives you the map of the territory where you have an unfair advantage. However, this map, as essential as it is only the first piece of the puzzle. It doesn't tell you what to look for within that territory. It doesn't tell you what specific characteristics separate a good business from a truly great one. And most critically, it doesn't tell you when to strike, what price to pay for that great business to ensure a margin of safety and a spectacular return. You have mastered the where. The what and the when are the next critical links in the chain. The video that is now appearing on your screen is designed to be that next link. It is the piece of the map that connects your territory of competence to the specific treasures hidden within it. Think of what you have just learned as the focusing lens of a powerful telescope. The video on the screen is the mechanism that aims that telescope at the right star at the right time. The journey from being an amateur investor to a sophisticated capital allocator is a process of assembling this complete mental arsenal. Most people will stop here, satisfied with this one powerful concept. But for those who are truly serious about achieving financial independence, for those who see this not as a passing interest but as a core life skill, the next step is not optional. It is essential. The choice is not simply to watch another video. The choice is to continue your ascent, to complete the framework, and to transform your financial future. Complete your arsenal. Click the video.